Okay. So, yeah, last lecture we were done till here. A very popular question in the papers. We have also understood this concept where, hi Ali, yeah, we have also understood this concept where we knew that companies can have different types of policies. One can be distributing same amount, one could be having the same payout. The other can be residual, where the first priority is given to reinvestment. Reinvestment is for survival and for growth. And once the reinvestment needs are taken care of, once the reinvestment needs are taken care of, then whatever is left, um, it's uh, uh, it's to be decided to give as dividend. Okay, you call that as residual. Okay, moving ahead. Okay, guys, you can see the screen, right? Hello, we
Yes,
can
sir.
see. Yeah. So alternative ways of distributing profits. So see, the chapter, particularly dividend policy, is about how the shareholders can be rewarded. Uh, as we remember, the excess cash can be given back to the investors in the form of dividends, in the form of buybacks, right? And dividends and buybacks, particularly dividend. See, legally they are not commitment. Legally they are not commitment. Behaviorally they act as commitments, because then the shareholder starts to expect that the company will distribute dividends with this frequency. However, in buybacks, there is no commitment attached. I mean, no legal, no behavioral. Why is that so? Because investors don't hope, don't pray that this year a buyback will happen, this year a buyback will happen, right? So this is something in which there is no um, commitment, no strings attached to the CFO. Okay, but are these the only two methods by which stockholders can be rewarded? Answer is no. Uh, Many times, guys, many times we would also like to give bonus shares. Bonus shares, a very, very popular way of rewarding the shareholders, which is also called as a stock or a scrip dividend. Stock or a scrip dividend. At times, this style of dividend can be pure. At times, it can be impure. Now, your question, what is pure impure? See, India mein there is no concept of pure impure, but in corporate e-finance concepts, yeah, there is a possibility of being pure and being impure. Okay, Kaustubh Shudi, what is pure impure, sir? So pure means, suppose company has declared a bonus of probably 1:5, which means one bonus share for every 5 outstanding shares currently held. Currently held. Okay, that's the way the company decides it. Okay. Now, suppose an investor owns 200 shares. So, a 1 for 5, according to 1 for 5, he will get 40 shares as bonus, as stock dividend, scrip dividend. But in impure, there is a choice. Tom, impure, Kaustubh, there is a choice given to the stockholders. Instead of declaring dividends, shares as dividend, they declare cash. And the option, a choice is given to the investor that you can avoid taking away the cash outside the company. And this cash can be reinvested back, and you will get more shares against it. The investor will get some proportionate more shares against it. See, understand what I'm trying to say. In pure, there is no choice. In pure, there is no choice. Kaustubh, there is no choice. You are being told, ki, sir, ye ratio hai, you will be given stocks as dividend. So your account will be credited. You don't want to have it, sell it off after earning it, after receiving it. But in impure, a choice is given. So impure may originally the offer is of cash. But a choice is given that you can choose not to take the cash out. Instead of giving you the cash, the company will retain that cash. It is as good as you reinvesting that cash back into the company and taking more shares from us. The rate will be fixed. Guys, are we clear? Correct? So pure, impure can be categorically understood. Pure, there is no choice. Pure, there is no choice. Impure, there is a choice. Choice is between money and stocks. Guys, are we clear?
Yes.
Yeah.
Yes, yes.
So here is the.
This is same as the bonus share, no?
Yeah, it's the same as bonus shares. So in the books, they also call it stock dividend or scrip dividend. Stock or scrip. See, particularly now, Tom. Particularly, I at times see this is something I'm happy. I'll take the credit that particularly at times I can recollect certain words which they can play in the paper. Correct. So ideally, if they do, then the teacher using the words in the classroom is helpful to a student because that time you'll be able to relate. The bonus was itself as stock dividend. You can just have a look here. The bonus was the same as stock dividend. Correct. At times, if I recollect, Kaustubh, at that very moment, if I can recollect, so it's an advantage to a student. Ki chalo, on the paper day, it's very clear that the bonus and the stock dividend are the same. However, Tom, in India, I have not seen, I don't think legally, because when I was reading, I was doing my chartered accountancy, I don't remember I ever read the impure, pure concepts. It's only in the UK actuarial content where they have given us, ki, yeah, there is, so there could, see, see, when we are doing when we are doing a corporate issuer, corporate finance type of a subject, business finance, we need to understand that we are talking from the purview of subject, not from the purview of the jurisdiction of the country. So world may, there are some places where there is this concept, where there is a pure, there is an impure stock dividend. So we need, Tom, we need to understand in pure, you don't have a choice. You as an investor, you don't have a choice. You are being offered stock dividend, take it. You don't like it, take it. You don't like it, take it, and then sell it off. Okay? So you don't have a choice. But in impure, yes, you are given a choice. So impure may originally we go back to the cash dividend only. Correct. But then you are given a choice. See, based on the cash you have earned, received rather, you're gonna receive that cash. You can choose to reinvest back into the company, and company will give you more shares. What's the advantage of this to the company now? See, what's the advantage? The company does not have to give away shares. My bad, cash. Company does not have to give away cash. So the best part is the stockholder feels rewarded. Tom, you are very smart for this. Bhavani ji, stockholder feels rewarded, correct? And the company very cleverly retains the cash. Cash is valuable, yeah. On a lighter tone, costume on a lighter tone. The other day I was asking raise Akash sir se. So he told me, I'll give you 12 more holidays in a year. On a lighter note, come on, did you understand? I don't know anybody. Hey guys, it's a light-hearted joke, please. Bhavani ji, Ali, oh, thank you. Tom, okay, okay. Taking that as a yes. Okay. So in addition to the regular as in money, which is usually paid quarterly, half yearly, sometimes one-off, special, extra, which is paid on occasions. Alternative to cash dividend include scrip, stock, share, which we call as bonus. If in exam you use the word bonus, I'm okay with that. Guys, if in exam you use the word bonus, I'm absolutely okay with that. Okay. Where the shareholders has no choice, so this is pure. No option no option to take cash or as a scrip alternative to cash dividend. Scrip alternative is impure. So it's a stock dividend. It could be pure, no choice, or it could be a choice where you could have a cash or shares. The alternative way is also giving buybacks. Okay, just have a look at this slide. We'll do a little number crunching around bonus. In fact, I'll teach you how to compare and contrast bonus and stock splits. Give me 2 minutes. Quickly, just have a look at this slide. We'll learn how to compare and contrast bonus and stock splits. Oh, sorry. Also, 1 second, dear. Kaustubh, is this clear and understood?
Yes, sir.
Okay. Just a minute. Now, if you want to write this, it will be good that you keep these notes in your books. So, discussing bonus vis-a-vis stock splits, and this is something we're not explicitly teaching it, but it hardly takes a minute. So, yeah, why not? See, there is a concept called as bonus, which we very well understood stock dividend. My bad. Stock dividend or scrip dividend. Also, just for today's lecture, don't mind, yeah, thoda sa, that medicine dose is causing drowsiness. The second option is what we call as a stock split. Don't worry, I'm focused. Stock split. Now, to understand this, let us create a standard example. Okay. There is a guy, let's say Mr. Ali. Mr. Ali. And let's say he owns stocks of a company. Hypothetically, the company is, let's say, TCS. Company he owns is TCS. Let's say he owns, let's say, 100 shares, whose current market price is roughly 3,000. Correct? Now, giving more data about TCS. Assuming TCS is a 300,000 crore company, so 3 lakh crore company with outstanding shares. Kaustubh, how many shares must be 100 lakh hoga kya? 100 lakh crore? Tom, to divide this, I'll get 3,000, right? 100 lakh crore? It's 3 lakh crore. No, 100 lakh nahi ho. Correct hai, Tom? Guys? No, 100 lakh nahi hoga na. It will be 1,000 crore. No, 100 crore. 100 crore shares. My bad. It will be 100 crore shares, na, Kaustubh? If you divide 3 lakh by 100, it should be 3,000, na?
3,000, yeah.
Correct? Yeah.
Yes,
It would be 100 lakh. Yeah, it would be 100 crore. What has happened now? Last few days, Kaustubh, watching so much of Trump data, watching so much of macro data, the numbers have started to run in lakhs of crores. You get what it means. Finally, chalo, let's move on. Yeah. So yeah, outstanding shares 100 crores. 100 crores. Moving ahead, let's say the total earnings of the company is maybe 10,000 crore. Okay. That gives you an EPS of 10,000 by 100, 100 rupees per share. The total dividend declared by the company, let's say is 10,000 crore. So we declare a 4,000 crore dividend. So the dividend per share works out to, plus 4,000 by 100 is 40. I would like to have right now, currently, the payout. So appreciate 40 on 100 is a 40%. I would like to have the dividend yield. The dividend yield would be dividend upon market price. Somebody help me, please. 40 upon 3,000. Is it a 1.33%?
yes, sir.
Correct. Maybe I'll like to have a PE multiple. The PE multiple will be MPS upon EPS. That would be a 3,000 by 100. That's a 30 times. Correct. So these are certain existing informations. Okay. I'm presuming you do not have a doubt. If you wish to take this down later, give me some time. Okay. Now what we'll do, we'll declare the bonus, check the impact on everything. We'll declare the stock split, check the impact on everything. Are you understanding the question?
Yes.
Kaustubh, Bhavani ji, you understood what I want to infer? We have taken a situation of a company. Then the company declares a bonus. How does the bonus impact all these variables? We'll take a stock split, understand the stock split, and again recheck how does stock split impact these variables. I believe we have understood. Hello. Okay.
Yes, sir.
You better copy these numbers now, so it will be very comfortable to discuss. Costu, you're copying? I mean, anybody, Costume just representing students. Ali, Tom, Bhavani, are you taking down these numbers?
Yes, sir.
Okay. Once done, please ping me. Guys, I'll just use the washroom and come. Okay, just give me 1 minute.
Yes, sir.
Guys,
Yes.
hello. Yeah, welcome back, please. Sorry, it took a while. Uh, yeah. So I believe we are done copying. Ali, Kaustubh, I believe we are done copying.
Yes, sir.
Now let's take. How many did we take? 100 CR, na? Okay. So let's go for a 2-for-1 bonus. Guys, one more item, na? Here I can also write, guys, somewhere please write down. Face value of this share is, let's say, 10 rupees. Face value of the each share is 10 rupees. Okay. Now, students, now guys, taking the data over here, there a little overlap is there. I'll take the data over here. Let's see. If the company declares a bonus in the ratio 2:1, what would it mean? That the total outstanding share will increase from the existing 100 crore plus you will have the bonus of 200 crore. That means the total outstanding share would be 300 crore. The face value per share would remain same, which is 10. Guys, are we clear?
Yes, sir.
Okay.
Yes, sir.
The MCAP, the market capitalization, never gets impacted. So market capitalization doesn't get impacted by the bonus. Theoretically, it should remain the same, 3 lakh crore. Tom, when I say theoretically it should remain the same, see, we need to understand this. Kaustubh, listen to this one, dear. Bhavaniji, we need to understand that, see, market has its own reaction, has its own brains. Okay. What you guys, we learn is what is contextual in the context of decision making. So a bonus, a stock split, they are all theoretical actions. I mean to say, they do not impact any raising or investing decision, cash inflow, cash outflow. Hence, logically, they shouldn't impact the MCAP. Logically. However, in real life, there have been, Tom, I was expecting that we both will react to this very fast. Also, in real life, bonus is something appreciated by the stock market. And in a short-term tenure, the companies who declare bonus tend to outperform the market. In simple words, if there is a bonus declaration, usually in a shorter time zone, the prices start to splurge. Correct? Contextually, in decision making, in finance, in subject, we say these actions have nothing to do with investing, have nothing to do with raising, so they shouldn't impact the MCAP. Are we clean and clear? Correct. So, Bhavani, academics may we would always take this stand that bonus, stock split, these are all corporate actions. They do not impact the MCAP, market capitalization of the company. Thank you, Ali. Tom, Bhavani, any point? Bhavani ji, Tom sir, any statement? Kaustubh?
All good, sir.
All good? All good. 1 second. Thank you, Tom. So if we take this context here, MCAP remain the same. Total earnings remain the same. I think it was 10,000 crores. Total dividend remains the same. That is 4,000 crores. But yes, if you say the price per share, the market price per share will now be 3 lakh divided by 300. 3 lakh divided by 300, that should be 1,000 rupees per share. The earnings per share would be 10,000 divided by 300. That should be, I think, 33.33 per share. The dividend per share, that should be a 4,000 divided by 300. This is the 300. That should be 13.9. 13. Is it correct? 13.33? Okay, 13.33. If we calculate the dividend yield, guys, a little time, space crunch, taking it here. If we calculate the dividend yield that would be dividend upon market price. Do a 13 by 1000, 13.33 by 1000, you get a 1.33%. If we do the payout, it would be a 13.33 upon, like 13.33 upon 33.33. It should be 40%.
Yes, sir.
And lastly, if we do the PE multiple, it should be market price per share, that's 1000, divided by 33.33, that's a 30 times. Continue it over here. Okay, this part. Now, if you see and compare, guys, screen is a little smaller, so you can compare all this with this data you had written in the past. You see, bonus increased the outstanding shares. It did not impact the face value. Guys, bonus had increased the outstanding shares, but it did not impact the face value. It did not impact the MCAP. It did not impact the total earning. It did not impact the total dividend. It reduced the market price. It reduced the earnings per share. It reduced the dividend per share. These all three, sorry, excuse me, dividend yield, payout, and PE remain unchanged. This is something which is very logical also. Why is that so? See, bonus, indeed, outstanding shares would change. ESC would increase. Face value would remain unchanged. MCAP doesn't get impacted. The totals doesn't get impacted. The per share numbers indeed will fall because the denominator has increased. In yield, payout, and PE, both the numerator and the denominator got impacted by the same variable in the same magnitude, in the same direction. Hence, those ratios remain unchanged. Anybody had a problem with the last line? The dividend yield, payout, and the PE all got impacted by the same reason, by the same magnitude, that too in the same direction. Numerator, denominator, both. Like EPS, like for example, like dividend yield. So DPS upon MPS, dividend fall, market price fall, same reason, same proportion. So the yield would remain same. Hello.
Clear, sir.
Lovely, lovely. Bhavani ji? Tom sir, Ali? Okay. Okay, thank you, Bhavani ji. Ali, thank you. So, yeah, thank you. So, this is the example which takes care of the bonus and stock split. Guys, would you like to pen it down, or you want me to take the stock split first?
Just a minute, sir. We will write
Okay,
it down.
please take down this. Guys, preferably, I would also like you to write the outstanding shares have increased, face value, no change, MCAP, total earning, total dividend, no change.
I'll ask you one question.
Sure.
Market capitalization is current market price in number of shares. Here, bonus shares in number of shares.
One second, Tom, you are correct. Just you have to be very patient.
Market capitalization increase.
Tom, little patience and hear the teacher, sir. 2 minutes. See, Tom, see, if A into B is equal to C, right? Indeed, C by A equal to B. Correct. Absolutely correct. I'm not debating on that. Okay. But if we ignore that simple math and you and me understand things in their natural way, not the mathematical way. Okay, sir? Everybody, you must hear this conversation. It's not nothing personal. It's not a conversation which I'm particularly proud of, but sooner or later people fall for this trap. Okay, this is a trap actually. Okay, Tom sir, I think I might have understood the doubt. If not, then I'll re-listen to you, sir. Just give me 1 minute to complete my line, sir. See, what happens, Tom, is the per share numbers are a function of the total and outstanding shares, all per share numbers, like market price per share, total MCAP, outstanding shares, earnings per share, total earnings, outstanding share, and so on, so on, so on. So every per share number is a function of two things: the numerator, the denominator. The numerator will be the total of that item, and denominator will be outstanding shares. Cool. I think it is done. Indeed, whenever bonus is given, the denominator will increase by default. Now, number of shares has to increase. It's a bonus, right? But you and me should first understand that the numerator will never get impacted. And why is that so? think of it the other way around. Cost of think of it the other way around. If bonus, stock split, any kind of such corporate actions which are under quite significant control of the CFO. These are under quite significant control of the CFO. If these things starts to impact MCAP, not price, MCAP of the company, then wouldn't it be very viable for the CFO to impact the MCAP just by declaring bonuses, just by declaring stock split, just by declaring. My point is, you and me need to be very, very clear that these actions do not involve raising, do not involve investing. Hence, they shouldn't impact the MCAP, but because it's per share and the denominator is number of share, hence the market price has to go down. However, what you were saying, sir, is absolutely correct logic. Sir, look, because the MCAP doesn't change, correct? So MCAP is particularly number of share times market price, right? So because the MCAP, see guys, everybody, Tom is adding new value to you. He's saying, sir, MCAP doesn't change, number of shares increased. So of course the MPS need to decrease to prove that line. Correct. See, again, that is again one way of looking at it, and it's not wrong. My way of looking at it, you should be saying that MCAP cannot change only, sir. Logically, theoretically. Why is that so? Because the decision what you have taken of bonus, of stock split are not involving any cash flow. Lecture 1, 2 decisions which can impact the value of the company are raising decision, investing decision. Bonus is neither. I would like you to think from fundamental perspective, not the mathematical perspective. Mathematical is a derived. Sorry, sir. Exactly. I don't want you to think from accounting aspect. Tom, in fact, if you relate to last time when we had discussed buyback also, in fact, Tom, I think we never spoke on this only. Tom, what's your background in education, sir?
Actually, I am science background, but accounts also, I have passed all these exams.
Okay. So, Tom,
I studied my own accounts.
Okay. So, good. So, Tom, particularly, at times we, Tom, see, we are to here online, right? We are to here online. And to be honest, I was not your first teacher. So I never had that, orientation to be done. Today we are starting this. But there are days where I do take orientation at the Andheri campus, Mumbai. Right? So there now, when we meet kids, we try to segregate them by asking in the classroom who are science grads, who are non-science grad, commerce grad, right? And when I introduce my subject business finance, Tom, when I introduce my subject business finance, the science guys always have somewhere a hunch that commerce guys will have an edge. Because by default, commerce guys will have an edge. Little terminology edge so they will have.
But so science people can learn accounts, but not account people cannot learn science.
Debatable but true.
Statistics and all, no, account people is
true. No, can't deny. Respectfully can't deny.
But we can learn accounts, no problem.
Yeah, true. And see, basically, again, we are deviating. I'll talk to you. We are deviating. My point is, remember this line in your life. Finance starts where accountancy ends. Now, only a commerce guy will be able to understand this fast. How is that so, sir? See, commerce, accounting is rule-based. There's no intelligence required. I'm myself a chartered accountant, so I am not insulting any person who has done commerce. It's rule-based. Rules are written under law, under some conventions, you follow them. Correct. It's convention, you follow it. Finance may, you are taking decisions. Accounts may, you never take decisions. Understand, contrast. For a finance manager, accounting data plays a raw material input. Using it and various other facts, he takes decisions. That's why going back again and again to, thinking accounting impact, it's secondary. We should be thinking about the money impact, financial impact. Yet, respectfully, some part of accounting needs to be learned to all. As Tom pointed, sir, he is from science, but he needs to learn commerce. Cost of accounts has to be learned. Why is that so? Because accounts are language of business. Accounts are language of business. If anybody doing any part of business, commercial, and you don't understand the language of business, then things are not good. Things are not in your interest. Guys, are we okay?
Yes, sir.
Okay. Yeah. Tom, you may continue with your example. What you were trying to push me on the TCS thing, sir. You were talking about something market price per share times number of shares is MCAP. Yeah.
Investment entry. So finance and accounting aspect, number of market capitalization will be more, but in finance we say it's an accounting entry. From cash to we are adjusting it to capital, right?
I couldn't understand, sir.
This bonus share, no, we are increasing the shares now. So equity, it will convert into equity shares, right?
Correct.
Yeah, that is what I am saying. So number of shares, my question was that number of shares are increasing, so market capitalization was increasing.
See, number of shares are increasing, correct. MCAP increases, I disagree. Why is that so? Because when the number of shares in the market increases, the market price per share will adjust accordingly in proportion, keeping the MCAP constant.
Market price was increasing. It may decrease. So
MCAP will decrease.
Market price will decrease.
My bad. Market price will decrease. Yeah.
Yeah. Understood.
Correct? Yeah. First up, is everybody done writing this part? The bonus.
Yes.
Okay. Everybody, Bhavani ji, Ali, Riya ji, everybody
Yes,
done?
sir.
Okay, Ali. Thank you. Taking it from the perspective of stock split. Everybody, if you go for a stock split is slightly different. Now, in stock split, what happens is, guys, in stock split is, as the word goes, stock split. Stock is split into many. In Hindi, Ali, I believe you are not good in, you might not be good in this. Just pardon me for 1 second. Riya, we call it छुट्टा कराया. छुट्टा नहीं कराते हैं 100 का 10 का 10 नोट 10 का 50 का दोनों. Ali, it's getting a big currency note split into a smaller denomination. So let's say you had a $100 note, which you got split into 2 notes of 50. The value hasn't changed. Bhavani, Tom, oh lovely Ali, thank you. So ideally stock split is nothing but getting your bigger currency note changed into smaller denominations. Correct? So please, it seems to be like close to bonus. It isn't. The implications are very much different. Please pay attention. See. Over here. Everybody over here. Suppose the company has a stock split in the ratio 2:1. Again, same data. So if the total shares were 100 crore shares of face value 10 each. 100 were 100 crore of face value 10 each. After stock split, the 10 will have to be surrendered. So when it's a 2:1 stock split, it's 2 new shares of lower denomination when you surrender the 1 share of the higher denomination. Whereas in bonus, it were 2 new shares credited to your account. You can keep the original one with you. Appreciate. Both the places I took 2:1 to contrast the difference. In bonus, under 2:1, you get 2 more shares, additional shares. Whereas in 2:1 stock split, you have to surrender the original 1 share of face value 10 and you will get 2 new shares of face value 5. So the face value is split down to 5, whereas the shares are 200 crore. So as you see, the total remains the same, 1,000. So as you see, the total outstanding share has changed. It was 100. It's now 200. and the face value compared to bonus, it was same year, it has gone down. The MCAP, the total earning and the total dividend doesn't change. They would remain same. We had a long discussion on this. They don't. The per share, because the denominator has increased, will decrease. So again, the per share numbers will change. So the market price per share will be 3 lakh crore divided by 200 crores. That's I think a 1500. Somebody verify this. Earnings per share will be a 10,000 divided by a 200. That's going to be a 50. And the dividend per share will be a 4,000 divided by a 2,000. That's going to be a 20. If we calculate the dividend yield, payout, and P, they would remain unchanged. The dividend yield, that's a dividend to market price, that's a 20 on a 15, that's a 1.33 again. The payout, it's guys, dividend to earnings, that's going to be a 20 on 50, that's going to be a 40%. And the PE multiple is the market price on earnings, that's a 15 by a 50, that's again a 30 times. Please, this is the example of your stock split. Kostu, please copy the example.
Yes.
Guys, what's the status? Are we done? Kaustubh, Tom, Ali?
Yes, sir. Done.
Okay. We'll take a 5-minute break on this. I'll teach you reverse stock split after this. Reverse stock split. I think we are done with this much, na? क्या कर रहे थे? हाँ. So we're discussing here. So we were discussing stock split and all. We are already done with the mathematical. Just this will require a little reading. I think we should be done with the chapter today. Yeah. Mostly the chapter will end today. Yeah, it's about to end. So okay, chill mind. Say we can do this. Take 5-10 minutes rest. Cost of I'll just take a small break. Uh, Post that we'll discuss the reverse stock split. It's just a theoretical discussion. Then we'll read the slides. We have to do a little bit of buyback and the ways in which buyback can be done. Okay, just give me 2 minutes, 2, 3, 5 minutes break. Thank you.
Yes, sir.
Yeah. Guys, continue. First up, Ali, Bhavani ji, come. Diya.
Yes, sir.
So when we talk about a reverse stock split, now, basically as the stock split went, it was kind of getting the stock split into more shares, lower face value. Reverse stock split is exactly reverse, where a lower denomination face value gets clubbed into higher denomination face value. So in case it would be 1 for 2, so you have to surrender 2 shares of the lower face value, and against them you will get 1 share of a higher face value. We are all good? Guys, Bhavani ji, all good?
Yes, sir.
Yes, sir.
At times it is done. Okay, see, I'll tell you. I forgot to tell you in fact this one. Tom, when you talk about stock split and bonus, the one which we had learned on screen, at times, Naria, you will find those companies, who have achieved like 5-digit number, 6-digit number, the MRF, the PNG and all. Those companies kind of prefer to give bonuses in stock split to bring their share into that range, which is an ideal range for traders, like a 2-digit, 3-digit trade. Nowadays in India, 3-digit is an okay range to be into. Like Nestle reached somewhere a range of 25 odd thousands, correct? It gave bonus, it gave stock split into a ratio where it is right now somewhere into 1200 rupees range, correct? Not all prefer to do that, but it is one of the viable reasons to do it. Why to declare bonus? Why to declare stock split? Costo, listen to this, huh? One dimension of the story is rewarding the shareholder, thereby not losing cash also. Keeping the shareholder happy that you got something, but not losing out on cash. It's like 2 birds, 1 stone. Okay. However, if you understand the stock market implication now, at times companies want their shares into such a zone where the prices are very, very liquid, because lot of traders are there into that zone. And once the shares are in that zone, some strategic shareholder might take an exit. Volume mein he can take an exit without the market price getting a hit. Guys, are we clear?
Yes, sir.
Okay, thank you. Chalo, we're done with reverse stock split as well. It's a reverse of a stock split. All the strategies done. We did the script. Yeah. Okay. Just have a quick look. Script dividend, alternative name for bonus. So from a shareholder point of view, there are less benefits. Tax will normally be paid as if cash has been taken, but since no cash has been received by the shareholder, this must be funded out of other sources. In simple words, see, you have to understand, when you receive bonus shares, you are not taxed, but when you sell the bonus shares, that time taxation will accrue. Okay. Scrip issue only benefit those shareholders who wish to increase their holdings, as they will avoid brokerage, other transaction costs, and also might get benefits of slightly better price. On the other hand, this practice complicates the calculation of tax, calculation of certain data. That's like for calculation of capital gain, the price. It's more like also in some jurisdictions they take bonus shares costing 0. So it creates complicated then which method to follow, FIFO, LIFO for income tax. So ideally, bonus creates trouble for calculation of tax implications. Hello, all good? Ria, Bhavani ji, all good? Tom, Abha?
Yes.
Yeah. Okay.
So we don't see reverse stock split very often in India.
Yeah, we don't. See, like stock splits, the intention was to bring the shares into a range. Sometimes even reverse stock split have an intention to bring the stocks into range. Means, imagine, okay, this is slight dark. Unfortunately, I have to teach you this. Imagine we are a penny stock. Okay, Kaustubh, we are a penny stock. Penny stock, somewhere single digit, decimals may shares penny stock. And we are friends with operators, mutual funds, let's say institutions. We want institutions to buy. Some kind of arrangements have been worked out. Now we want institutions to buy our shares, but the institutions face a mandate that their rule book says they cannot invest into penny stocks. So how to not make our penny stocks? How to not let our penny stocks remain into that category? We can declare reverse stock splits. Maybe 10:1. What happens 10:1? You surrender 10 shares of the lower face value, you get 1 share of a higher face value. MCAP remains the same, the market price becomes 10x of what it was. Assuming the market price become 10x, you are no longer into the penny stock category. Now institutions can start buying. Maybe your stock price now becomes higher. At times, Kaustubh, you want to push the price into a zone so that some strategic shareholders can take an exit. The other day, this is dark but true. Other day, like I'm presuming anybody who's watching markets nowadays, you see SME stocks prices. Almost 80 to 90% of the stocks are 80, 70, 80% lower than their issue price. So these are some things which tell us that, these market is nowadays markets are being used. See, I can't use the word nowadays also. It's coming out in limelight every time, people use it to get an exit. The IPO is many times used by the VC PE to take an exit, right? So ideally, many times you see strategic shareholders who want to exit, they want the stock into a particular range, and stock split, reverse stock split can facilitate the stock to get into that range. Kaustubh, all this is dark side, but true. I mean, everybody knows this. We avoid open communications around this. But
Yeah.
these are facts. Kya kare? Abhi, the other day, there was a buzz on the street. I think, what was it? Zomato? No. Oyo. Ola Electric, right? Ola Electric. Around 15-20 days ago, if my memory supports, Bhavesh Agarwal, right? Ola Electric, Bhavesh Agarwal, right?
Yes.
Agarwal ji took a lot of huge stock selling, I think 30-40s ki range mein. Then his PR team made a communication. No, it was to clear off his loans and all that. The other day, market rose. The retailers started to feel that no, it's a normal exit. And the very day he sold 200 crore or 150 odd crore, I don't remember the number. You can Google out huge number of shares. So, see, the fact of this era, which has come into limelight, is intentions of businessmen, especially the startup culture, is not to sustain the business running. They just want to set up things, get into the IPO frenzy, get exit. In fact, I know people from day one, their business motive is this only: to set up any venture, boost the top line growth. Correct? Don't care about the bottom line. You understand, na? Revenue growth should be there, get the customers by anyways. They don't care about the profits because anyways market will give them some kind of a multiple on the revenue, 4x, 5x, depending on what growth stories they push to the investors. And then they can very comfortably make 100 CR, 500 CR. That's like cost of intergenerational wealth here. Generational wealth. I mean, 100, 200, 500 CR, given a very, very, luxurious life, it's a generational wealth creator. So intention is very clear. I'm nobody to comment it's good or bad. In fact, rather, I would say that I can't do it. So that's why I might be cribbing around it. Correct? Costo, but it's a fantastic thing to do. If the marketers frenzy, it's their problem. We can use their exuberance to make money. Na? What's the big deal? That's how world makes money.
Yes.
Unfortunately, this will get recorded. No problem. Okay. Bhavani ji. Yeah.
Sir, getting some out of context, like if you remember, there was a share called LCD Investments. So that was not the case. I don't think so. That was the case
No,
of
no. What has
restock,
happened with
but there was some valuation.
what has happened with LSID na, is somewhere in the last July. Because I've saved that article with me. If you want, I'll send it to you. Many
Yeah,
many
yes,
students
please.
come out with that LSID, BBTC, Kalyani Steels. There is a whole group of you call them holding companies. You call them holding companies. So market, I think SEBI had created some auction scheme in which all these companies needs to get closer to their value. And this LCD was trading at 1 to 3 rupee range. Nobody trading the stock, holding tons and tons of Asian Paints, and market knew, but nobody traded. Na, like similar stock you see today's Taparia Tools. If you follow it, Taparia Tool. The other day, if you remember, we had seen that dividend yield wala chart. In that Taparia Tool was number one, right? So see, that is not the category here. LCD was a very different story where again it's I mean I'll put a very weird way, Kaustubh. If you me own Elsted na, even with the 1,30,000 rupees, I think yesterday or day before I saw 1,30,000 odd it is going, you would not like an exit because the fair value runs in 3.5 lakh rupees.
Yeah, yeah.
Means you and me, we are not Instagrammers or YouTubers where we just want to create a hype. A 3 rupee share became 2 lakh rupee share. Arey Baba, वो 3 rupee was because nobody was doing any demand supply only. Market has to match, na? There was a lot of demand. Nobody is supplying. Who will sell the share worth 3,53 rupees? Correct. Then SEBI introduced some kind of an auction scheme. I have got that on my phone. If you want, I'll send it to you. And because of that, all these holding company stocks, gave a good rally. LCD was a outlier in that. I mean, it gave something fantastic, but it has nothing to do with the reverse stock split. There is a good chance that what you created analogically, that so there is a chance that some people who might be holding LCD might take an exit. Yeah, why not? I mean, but again, Kaustubh, they should have exited when the first day listing happened, that 2.5 lakh series wala. Now to you see, it went daily lower circuit, and today to it is somewhere 1,30,000 odd. Correct. See, holding companies in India trade roughly into a discount of 60 to 85%. So suppose the fair value is 3.5 lakh rupees, the stock range now will range in this only, 1.5 lakh rupees. And as the underlying prices will go up, even that 1 lakh rupees will go up. Like if you happen to do a little research on holding companies, na, they always conventionally have a range in which they trade. Correct. So maybe people took an exit, good chance, when it was 2.5 lakh rupees. And now, if your question is, sir, chalo, I've got a crore rupees, cost to bless you with lots of money. Let's say you have a crore rupees, 5 crore rupees. Sir, should I invest into LCD? See, again, it's an undervalued stock, but appreciates the holding company. Holding companies always trade at discount. So for you to make money, two things should happen. The discount should narrow. I mean, instead of 60% discount, it should now be like 50% discount, 40% discount. So automatically you will get more money. Second, the underlying shares, like in LCD, Asian Paint, should go up. So double delta we are playing. Two variables basically.
Yes,
All good?
all good, sir. Clear.
You track these holding companies?
I started to track them, but I didn't continue that.
There is one of the holding companies which is my personal favorite. It is BBTC, Bombay Burma.
That Bajaj Finance and that
No,
company.
it's Britannia. It's Britannia.
Okay.
Bombay
There is a
Burma.
company also that holds Bajaj
It,
Auto and Bajaj
it,
Finserv
think
shares.
it should be Bajaj Holdings.
Maybe. Yeah.
Should be
That
Bajaj
was also
Holdings.
undervalued.
All holding companies, cost of all holding companies per se worldwide trade at a discount. All holding companies. Correct. So whenever you bet on a holding company, na, you have a lot of safety margin. Number one. But the problem is, na, the market does not recognize the delta the way you and me talk in classroom. So you buying, like if I can take just 1 minute from you, if you happen to see BBTC chart, BBTC is quite a famous classroom example. We'll be taking that in the future chapters to come as well. See, if you see BBTC long-term chart, here's the long-term chart. So nobody's recognizing its value. 30 rupees and somewhere now 1800 rupees odd. So I think it's a 50-60x story in the span of 20 years. But if you see its underlying, Britannia, BBTC owns more than 50% in Britannia. If you see the beautiful chart, so this is like a 40 rupee stock trading at 6,000 rupee. I think it is like a 50-60x thing. What is it? 40 rupees becoming 6,000. 150x?
Yes,
50x. And what was BBTC's multiple?
around 50-60.
50-60. So you may see na ki it has grown. It sounds very good, na 50x. But see, it has not grown the way the underlying went up, na. I mean, if you had a choice, why would you go with BBTC? You would have gone with Britannia. So the underlyings have moved at a very, very faster pace. And that's why you see BBTC is trading at a steep discount. So when it is at discount, you are interested. But the question is, when does the discount unfold? Because for you to make money, market has to unfold the discount, na. Because as an investor, Tom, Bhavani ji, as an investor in stock market, you love the days where the things are at discount. But finally, when you want to exit, you want the discount to unfold. I mean, yesterday was a good buying day, provided you had money. Correct. But you don't want every day to be like yesterday. Na? You want to exit also someday. Correct. You don't want things to remain at discount forever. I think we got it. I think we are unnecessarily talking on
Yes, sir. Yes.
Okay. So buybacks, if a company has accumulated large cash, guys, read it. I've already taught you this, so I don't think my effort is required. Just quickly read it. Guys, done? Guys, read it?
Yes, sir.
Yep. Okay. Moving ahead. So the issues with buyback is some investor may want to have capital gain. Some doesn't want capital gain. So there is some taxation related issues. However, the effect of buyback on earning per share is good because the denominator will go down and the EPS should increase, right? Guys, a testable question paper. Techniques of share buyback. Tom, a little technical area, legal side pe. The company can have various ways, procedures to have buybacks. Number one, the company can decide to buy back from the market itself, telling a range that the company, for example, Infosys decides earmarks 10,000 crore and says that from 1st March to 30th June, they will use this 10,000 crore to buy a certain number of shares from the market. It's an open market. So gradually, it will repurchase over a period of time. Fixed price. So here, the company tells to the shareholder that we are willing to buy back from you at this particular number. Usually the number is above the market price. Tender will talk. Repurchase by direct negotiation usually is with strategic institutional shareholders, where the company can talk to some strategic shareholders and buy back shares from them in person. You don't have to go to the market. You can talk to individuals, right, and get the buyback. Now, this is something very interesting. Tender offer. What happens here is, in tender offer, you also call it Dutch auction. First, here the company gives a range. Say, for example, company says that we are willing to buy back maybe 1 crore shares from the range of 800 to 900 rupees. Okay, guys, listen to this. We're happy to buy back 1 crore shares in the range of 800 to 900 rupees. But you, shareholders, have to bid for it. Okay. Listen to this, please listen to this. This is a little technical. So let's say Ria I told her, Ria, you have to bid for it, 800 to 900. Remember, I am the buyer. So for me to accept the bid should be on the lower side. I mean, a bid for me, which is lower, is more attractive. Na? Guys, this is a buying auction to me. Hello. Correct. Lovely, Ria. Lovely. So let's say Ria gives a quote. Okay, sir. 800 to 900 range. Now I have 1,000 shares. I would like to tender off my 1,000 shares at 800 rupees. Costume says, no, I don't want 800 rupees. I want 805 rupees. So costume says, okay, 500 shares at the rate 805 rupees. Aisa everybody, I'll arrange their bids in a particular order. Hello. All good? Guys, all good?
Yes, sir.
Then I have got an amount, the number of shares, an amount which I will use for buyback, right? Yeah, number of shares which I want to buy back. Now, imagine I want to buy back 50,000 number of shares. So let's say Ria gave 800, Kaustubh gave 805, Abhar gave 806, Bhavani gave 809, and so on. Tom, in ascending order, arranging them, let's say at Tom, my 50,000 shares, the one which I wanted to buy back, ended. But Tom gave me a quote. Let's say Tom is on the little greedier side. Tom gave me a quote of 830 rupees. Guys, till here it is clear. Ascendingly arranged. 50,000 number of shares I want to buy back. Tom is the last guy. Beyond Tom, it goes 50,001, 50,002, and so on. So my area goes infeasibility area. Tom gave me the final number of shares, and Tom gave me a rate 830 rupees. Surprise, surprise. All of you, Ria, Kaustubh, Abhar, Bhavani, in the order till Tom, everybody will get 830 rupees. Kaustubh. So what happens here? Ria, by bidding the lowest, increased her odds. In a way, I nudged everybody to stick on the lower side. Guys, as a buyback guy, I would like the price to be lower because I'm buying it back from you. So tender offer or Dutch offer very cleverly fixes in the mind of the investor that if you want higher odds, then better you quote the lower number. Guys, is this clear?
Yes.
Only the differential aspect is, at Tom it ended at 830. Although Ria had quoted 1,000 shares at 800, her 1,000 shares will be bought back by me at the rate 830 only. Guys. All good?
Yes.
All good? Okay. Just have a look at tender offer. In Dutch auction, the company states a series of price, a range. Shareholders reply to the offer, informing the company of how many shares they are willing to sell at each price. So the company then calculates the lowest price at which it can buy the required number of shares. Are we clear? Guys, are we clear?
Yes, sir.
Okay. Last slides, markets and dividends. This is like simple concept. Remember, value of we are done. So I'll call it a day once the slide ends. We're done with the chapter anyways. See, remember, Kaustubh, this is not the part of your curriculum. What? Valuation. Okay. We learn valuation of shares. Where what do? We try to predict the future cash flows of the company. Old school model says try to predict the dividends of the company. So D1, D2, D3, D4, and so on. try to measure till d infinity, use some model, and then discount the future cash flows to get the PV, present value. And once you get the present value, you compare that present value with the market price of the company, market price per share of the company. After comparing, you can make a call that whether the stock is undervalued or overvalued. So basically, dividends are those cash flows which gets discounted to find the present value of the company. And once the value is found, you compare the value with the price of the company. These are old school models, very famous back in 60s, 70s, 80s. They used the proponent used to be Myron Gordon's model, dividend discounting. However, nowadays people don't use dividend discounting. They are switched on to free cash flow discounting. So the markets and dividends are just trying to relate those slides. Guys, you may have a look at this. Have a look at this, please. Also, Via, if anybody can read it for me. Hello.
Yes, sure.
Yeah.
The market value of a company is the market's valuation of future dividends, unless there are expectations of takeover or winding up and the distribution of residual assets. If no outside loan capital is available and the company has better investment opportunities, then its shareholders, the payment of dividends will reduce the business's ability to take advantage of these situations, and will be damaging to the market value of the company.
So if the company has better reinvestment opportunities than the stockholders, so it is better that the investors don't expect dividend. Guys, just 1 minute. Give me 1 minute. You read the slide. I'll just be back. There's somebody on the door. Yeah. So if the company has better opportunities, then of course declaration of dividend was bad. Why is that so? Because declaring dividend took away those opportunities from the company. Come on, am I making sense to you? Students, are we there?
Yes, sir. Yes.
Lovely. Costo, please continue.
However, provided loan capital is available to the company on tolerable terms, this restriction does not apply. And even after this is exhausted, there is always the possibility of a rights issue. Looking at the dividend question from the point of view of the shareholder, it is reasonable assumption that the purchaser of share has some expectation of a dividend policy. If this expectation is not fulfilled, it will change the investor's relative valuation of the share.
So if the expectation isn't fulfilled, there is a good chance that the stockholder will be unhappy with the company and might sell off the shares, right? Costo, this rights issue, you ask me in the sources of fund chapter. Remind me this sources of funds, long term, and I'll teach you there some numericals around it. Okay, please, pakka. Ria, Bhavani, just remind me this. Okay. Last slide, please. Costo, I'll take it. A consistent dividend policy, therefore, consistent, whatever you are following, follow that, is building a clientele. This is very interesting. See, Costo, we were blaming the shareholders for, expecting the dividend. But don't you remember, it is you who made the shareholders expect the dividend. I give you the other day the example, the students were asking for a tea break. So it was the teacher who gave the break and the students' expectations start building up. Student was not at fault. Same way, shareholder is not at fault when he's expecting dividend. It is the company who made him fall into that category that you have to expect dividend. So you attract people whom you want to attract. Remember the line. You attract people whom you want to attract. How is that so? Because whom you want to attract, you will take actions based on that clientele. Guys, come on. Correct?
Yes, sir.
The financial management of the company must therefore consider carefully the likely effect of the investor's perception of any dividend announcement. Correct? Guys, an efficient market will take its cue from the statement and the actions that enter the public domain, not from what managers think or wish. I mean to say, you have to be very cleverly playing the market card, because market will be reacting on the actions you took and not just on your words or your feelings. Come on, all good?
Yes.
Perfect. Chalo, Kaustubh, finally we end the chapter. Next chapter will take something else. Planning to go for types of entities, interesting. Then maybe taxation and long-term, short-term sources. Hello, all good? Everybody enjoyed?
Yes, sir.
Chalo, see you next time we'll meet. Thank you. Bye-bye.
Thank you, sir.
Thank you, sir.
Welcome, dear. Bye-bye.
Thank you,
Thank you,
sir.
sir.
Welcome. Bye-bye. Take care.